Right now, a massive institutional capital flight is quietly draining the XRP ecosystem. For US investors, ignoring these outflows means overlooking the same liquidity signals that trillion-dollar asset managers are currently front-running. Retail traders look at XRP holding strong at $1.32 and assume the token is simply resting in a safe, predictable consolidation phase. But look under the hood, and the data reveals an active, aggressive market squeeze. This chart tracks available XRP on open exchanges, crashing to a multi-year low of precisely 0.043, and the data shows whales systematically draining these exchanges, moving massive volumes of XRP off the open market and directly into private, long-term cold storage. By the end of this video, you'll understand the 4 institutional shifts driving this squeeze, and exactly how the market reacts when that supply finally hits zero. Ripple is aggressively expanding its corporate footprint. This week, they filed a series of powerhouse trademark applications designed to launch an equity prime brokerage, decentralized exchanges, and clearing services. When you pair those new brokerage services with Ripple's recently acquired national trust bank status, the company transitions into a fully compliant, all-in-one ecosystem custom-built for Wall Street institutions. The overarching catalyst for this transition is the bipartisan Clarity Act. This legislation aims to permanently crown XRP as a recognized federal commodity, placing it strictly under the jurisdiction of the CFTC. The Senate Banking Committee has already cleared the path for this new classification with a commanding 15-9 vote. Institutional investors are already front-running the final legal ink. Big money has poured a staggering $1.4 billion into spot XRP ETFs. These transitions happen fast, and retail traders are the last to know. Hitting the subscribe button for Crypto Global News is the only way to get these insider timeline alerts before the rest of the market reacts. By securing these federal licenses and institutional partnerships, Ripple has effectively moved XRP from the fringes of crypto into the heart of the institutional financial stack. On the technical side, the network itself is locking up supply through the newly published AMM version 2 upgrade on the XRP ledger. This upgrade introduces advanced stable swap and concentrated liquidity features, locking them tightly together directly on the ledger. By supercharging capital efficiency and wiping out slippage, it creates a frictionless, high-speed environment for institutional stablecoins and tokenized real-world assets. As banks deploy those stablecoins and real-world assets, they must permanently lock up massive amounts of XRP capital to operate the liquidity pools, which removes that supply from the open market. All of this underlying pressure collides directly with one specific metric, that incredibly thin 0.043 exchange liquidity. Stacking the $1.4 billion in ETF demand, AMM liquidity locks, and aggressive whale hoarding pits an overwhelming wall of demand against a microscopic supply. The mathematical reality is severe. Market depth is so thin that standard sell pressure has effectively ceased to exist. Because this vacuum is so deep, even a tiny spark of fresh buying volume will trigger a massive short covering rally straight through the $36 and $50 resistance walls. For our viewers in the US, the window to act is closing fast. Head over to our community post right now and vote on whether you think that $50 wall breaks this week or next week. Every available metric, from ETF inflows to whale withdrawals, points to a supply gap that the current exchange liquidity simply cannot sustain. Ripple isn't the only network making this transition. There is a similar institutional pivot happening on another major ledger right now. Click the link on your screen to find out exactly how to front-run it before the institutions lock that supply up too.
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.